Turn your portfolio into a cash machine with the wheel strategy. Hope you're all having a good day. Let's dive right into it. The wheel strategy is a repeatable options income method where you sell cash secured puts to acquire shares, then sell covered calls on those shares, cycling each expiration. The first step in the wheel strategy is selling a cash secured put involves selling a put option while having enough cash to buy the underlying shares if assigned. You're going to choose a strike price that is below the current market price that you're comfortable owning the stock at. You're going to receive an upfront premium for selling the put option, which is yours to keep regardless of the outcome if the option contract expires worthless or you are assigned and have to purchase those shares. You need to ensure that you have the cash equivalent to 100 shares times the strike price to cover the potential assignment. And so if you bought a $100 strike price, you need to make sure that you have $10,000 available in your brokerage. And you're going to select an expiration date, typically somewhere between 30 and 45 days. You can choose a weekly expiration date as well. It just depends on how you want to run the wheel strategy. The next step of the wheel strategy is simply option assignment when the stock price falls below the put strike at expiration. And that just means that you're going to buy 100 shares per contract at the strike price using the reserved cash. You're going to keep the premium from selling those put options, and that's going to reduce your overall effective cost basis. And now you own the shares. Now that you own 100 shares of the underlying stock, we can now move on to the third and final step of the wheel strategy, selling a covered call. So with those shares assigned, we can sell a call option to generate additional income while holding the stock. It's important to pick a strike price above your cost basis to ensure a profit if those shares are called away. You're going to collect another premium, further reducing your effective cost basis, and you need to be prepared to sell shares at the strike price if the stock rises above it. And so it's very important to select a strike price where you are comfortable selling your shares at. If the call expires worthless, meaning that at expiration the stock price is below your strike price, you can repeat the process. Before moving to the actual example in the brokerage, here is a visual of the wheel strategy in action, everything that we just covered. And then we can talk about the risk management. Risk management within the wheel strategy, always reserve enough cash for every contract that you sell for your cash secured puts to avoid margin calls. Your brokerage will hopefully do this for you, but if your brokerage does allow you to do something called naked puts, just monitor your trades very closely and ensure that you don't get margin called. Essentially, that just means that you do not have the funds available if you are assigned those shares. You can also use stop orders or protective puts to limit your downside risk on the assigned shares. A little bit more of an advanced topic. You could also roll your puts, topic for another video. Finally, just make sure that you diversify across multiple stocks to reduce your overall exposure. You could also just run the wheel strategy on ETFs like the S&P 500 or SPY and the NASDAQ, so QQQ. Overall, make sure that you're running the wheel strategy on stocks that you are comfortable owning because that is a key piece of the wheel strategy. Now that we understand what the wheel strategy is, the core steps involved, and how to manage risk, we can hop over to the Robinhood brokerage and we can see this in action. And so the first step of the wheel strategy is selling a cash secured put. In this case, this is expiring on May 23rd. And we can go down and look at our options available, and we can select maybe the 105 strike price, and we can see that the delta is a 0.3, gamma is 0.02. So for every $1 move in the stock, delta will go up or down by about 2 cents. And so you can think of delta here, this 0.30, as you have about a 30% chance that you'll have to purchase these shares by, May 23rd, right? So NVIDIA on May 23rd could be 105 or below. There's about a 30% chance that it happens. Okay. And so if I'm comfortable owning NVIDIA at $105, I can go ahead and sell this put contract. And you can see that I have to reserve $10,500, right? The strike price times 100. And I'm going to collect $300 for selling this contract, right? So what this means is on May 23rd, if the price of NVIDIA is above $105, that $10,500 that I reserved is going to get released back to me so I can, do this trade again next month, and I get to keep the $300 premium. Now, the second step of the wheel strategy is if I get assigned on these shares. So let's imagine now it's May 23rd. The stock price of NVIDIA has dropped to $105. I get assigned those shares. That means that I now purchased NVIDIA at $105 per share, and I received $300 in premium. That just helps my cost basis on the stock itself. As we now own 100 shares of NVIDIA, we can move on to the third and final step of the wheel strategy, which is selling a covered call. And so I can go over to selling a call option. I can go to a 6-day expiration date. And the reason why I chose a 6-day expiration here, for sake of example, is when I am selling a covered call, I prefer to have a shorter expiration window. The reason is I want to try to capitalize on capital gains and collect that premium and get out of the stock as quick as I can so I can go back to step one of the wheel strategy and sell cash secured puts. To keep this example of a covered call as simple as possible, let's assume that our cost basis for NVIDIA is $110 per share. Okay, so what that means for a covered call is that we need to select a strike price greater than $110, right? So that we can make sure we make money on the capital gains. And so if we look at the $115 strike price, we could take a look at the Greeks, the bid-ask spread. Everything is looking pretty good. See, there's a lot of volume, which is always a good sign. Uh, Typically, that can indicate that the premiums are going to be higher. NVIDIA is one of the the most traded stocks in the market, so we would expect to see quite a bit of volume here. But getting back on subject, so the delta is a 0.3, right? So there's about a 30% chance again that NVIDIA would be $115 or above by May 2nd, right? Which is our expiration date. And so if we take a look at this contract and we say, hey, I own NVIDIA at about $110 per share. I am selling a call option at the $115 strike price. Am I okay with collecting $131 and having to sell my NVIDIA shares at $115 if NVIDIA hits this price? Right? So that would mean I would collect about $5 in capital gains, right? 115 minus 110 plus collect the premium. And so if those check all the boxes and I'm comfortable with that covered call, then I can go ahead and buy this contract. And so again, really quickly, just going over this because it's super important, right? To understand that if NVIDIA is $115 or more, at the expiration date, you are obligated to sell the shares, right? So you would have to sell your shares at $115. And that's why your break even is $116.31 is because you received $131 for selling the contract. Okay? The reason why you see some red here is because if NVIDIA continued to climb and it went to $118, you're missing out on a little bit of those capital gains, right? But you were already okay with selling at 115, so you take it as a win and you move on the next week to selling cash secured puts or whatever you want to do, right? And again, if the stock price of NVIDIA is below your $115 strike price at expiration, the contract expires worthless. You obviously will still keep your $131, but then the next week you can just put this trade on again, collect some premium, and see if NVIDIA hits that price or not. If any of this was confusing, just let me know in the comment section below. We can maybe make some videos in the future of just covered calls or just cash secured puts and really dive into every detail. That wraps up our video on the wheel strategy with NVIDIA. If you have any questions, put them in the comment section below. I hope you have a great day, and we'll see you in the next video.